You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Monday. Today we're going to talk about selling because selling is darn tough. It's difficult. For example, last year I had to sell shares of Alimentation Couche-Tard, ATD, and Apple. And I think I also sell a few shares of Microsoft. So pretty tough year for me because I don't want to sell my winners. But on the other side, I don't want to hold on to them for too long. I remember that at one point I was making almost double my money on Sylogist, and I held it because I thought it would continue to go up, and unfortunately it went down. So when the price is up, you want to capitalize on that gain, and it's just totally normal. It's human, right? Because after all, paper profit is no profit. So the question is, when it's time to sell stocks. I got a question more specifically from a member, and he was relating not from like a super winner, because I already have like a rule. Whenever one of my holdings goes above 10%, I will trim that position. But that's like risk exposure management. I don't want to have any of my stock. I don't care what it is. I don't care if it's driving. I just don't want to be exposed to a large potential loss in the event that I could be wrong. Because unfortunately, we must also all admit this as an investor, we will be wrong. So I have this 10% sell rule where at any point when one of my holdings cross that bar, I will trim by about 2%, bring it back to 8. So that helps me to keep my winners winning and like lifting my portfolio literally. But at the same time, I will never wake up one day losing 8, 9, 10% of my portfolio because my biggest winner is crashing down for whatever reason. So it's kind of like a way of protecting my portfolio from myself. But my member had a pretty specific question, which I thought was quite interesting. So it was relating to a safe stock, a low beta, like those hold on forever type of businesses. And then he was like, yeah, I'm up like 20% or so. So should I sell or should I trim or like, should I take any action? And I thought it was a good example because it's easy to have clear rules like, oh, I'm up 10%. I'm up to 10% of my portfolio and then I sell. But what if you have like a regular size position, like a 3% or a 4% weight on that specific stock? And then it's up 20%, maybe beating the market. And then you're wondering, well, maybe it's time to cash on some of that profit. It's tempting, like the money's on the table and it's up to you to take it or not. But to make it more real, I decided to take an example. And that's not what the member was referring to, but I just thought of Fortis. Fortis, FTS.to, also trades on the New York Stock Exchange under FTS, is a pretty good example, and that would fit to that description. Very safe stock, regulated utilities, mostly doing business in North America, so Canada and in the US. Grew by acquisition, but not too aggressive. Debt is under control. Has a crazy long time dividend growth history, 50 consecutive years with a dividend increase, usually around 5-6% a year on top of that. So easily beating inflation. Very low beta, which means that whenever the market goes crazy, this stock will not. So sounds like a pretty solid protection against market swings. On both ways though, because the beta is not just about like when the market goes down, but also when the market goes up. So it just tells you that how the stock price like fluctuate as little correlated to the stock market, which could be seen as a good thing, especially during high volatile periods. And I decided to take Fortis because over the past, since the beginning of the year, it's almost up 20%. Not there yet, but pretty good on target, like 17 if you count the dividend. So total return always, stock price appreciation plus the dividend. You're almost up 20% this year on a pretty boring, pretty safe stock. So what should you be doing at this point? Should you be selling a part of it? Should you move on and cash completely? Because Fortis is not known to be a strong grower. It's not a super powered business. It's not an exciting one like a tech stock or like Stella Jones that has been like ripping off like crazy, going up like there's no tomorrow, or TerraVest for like, I don't know that company that much, but I just saw like the stock price going like so up so fast. Fortis is like sleep well at night, boring, just like your grandfather type of stock, right? And on top of that, if you look at the poor performance, relatively poor performance of the stocks over the past 3 and 5 years, not even able to beat the TSX. So that comes back to that question of like, well, should I cash that 20% gain? Because this one is not a big winner, right? It's not like an impressive one. And well, my answer to that would go back to say, what's the role of Fortis in your portfolio? What's the role of that safe stock with a low beta? I don't care about the performance. Like, it's the role. I do have Fortis, full disclosure in my portfolio. And of course, I focus a lot more on growth, right? I'm a bit of an aggressive dividend growth investor, looking for companies that are thriving, that are exciting, that are generating high single to double digit revenue growth, earnings growth, and dividend growth. And Fortis doesn't exactly fit that bill, but I need to have those type of like safe and steady stocks in my portfolio to bring some stability whenever the market goes down. Because this one, I know I can sleep well at night and I will likely hold until my deathbed. And that's the question. Are you focusing on short-term performance, like cashing that 20%, or do you have like long-term success in mind? When I invest, I think in decade. And it's kind of ironic because if you look at the past 10 years total return for Fortis, you would be up 162%, so stock price plus dividend, versus about 117 for the TSX. So you would beat the market over 10 years, but you would lag over the past 3 and 5 years. So it's all relative to your time horizon and the role you want to give to that stock in your portfolio. So what I would do if I would see a safe stock in my portfolio being up 20%, like pretty much if I look at Fortis today, if I was doing a portfolio review, well, I would keep it. I would keep it mostly because I don't care about short-term performance. What I do care about is what is Fortis' business model, what they're doing, and is it backed by a strong dividend triangle? And if it's the case, which is for Fortis, my investment thesis is clear. It's aligned with the dividend triangle. So I just want to have like a stable, well-diversified, 100% regulated utility in my portfolio, predictable cash flow, steady dividend growth that will protect that cash flow will be protected from inflation with constant dividend growth increases. That exactly the role that it will play for Fortis. And when I look at the dividend triangle, I see that revenues are growing, earnings are growing, and of course, the dividend as well. If you are looking to have a better sense of a methodology to build that kind of portfolio with solid, safe stocks that will generate a predictable income at your retirement, I am hosting a free webinar about retiring. So the webinar is all about creating a safe income for your portfolio. And also we're going to talk about how you can optimize your withdrawals. So the sequence of withdrawals, how you can prepare your portfolio to start withdrawing money from it. So all about this in my next webinar that will happen this Thursday. So you can register for free at moosemarkets.com/webinar. moosemarkets.com/webinar. The webinar is free. It's on Thursday, September the 19th at 1 p.m. Eastern Time. There's 101 person already that registered. So we're going to hit more than 1,000 registrants for that webinar for sure. Limited place for the live event is at 500, so log in early. And if you cannot log in or if you cannot watch the live webinar, you can always catch the replay, but that replay will only be sent to those who have registered. So once again, moosemarkets.com/webinar. And as for those low beta safe stocks in your portfolio, well, why are you like such in a hurry to sell those, right? I think that having like those solid block in your foundation is crucial, especially when we don't know what's going to happen in the market. And for sure, this fall will be quite entertaining. All right, Moose, that's enough for today. We're going to talk again tomorrow. And until the next time, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.